Have you ever felt that, that weird disconnect where you hear the economy is supposedly growing, but then companies seem to be really, really struggling?
Mm-hmm.
Industrial production is growing. On paper, we see the numbers, but underneath, profits are just melting fast.
Yeah, it's a real paradox.
And we're seeing a record number of companies actually reporting losses. Financing costs are eating up, like more than 80% of their operating income.
It's an incredible figure.
Meanwhile, you look at investments, and gold is shining again. It's the top performer. But the overall macroeconomic picture, it feels fragile. It feels like it's deepening.
Right.
So is a crisis actually looming here, or are these just maybe side effects of some deeper structural imbalances? That's what we're getting into today.
Exactly. We're taking a real deep dive into Turkey's economic pulse.
We'll be dissecting this whole nuanced reality behind the headlines.
And our mission for you, the listener, is really to pull out the key insights from some critical sources. We're looking mainly at the Two Black Dot Weekly Financial and Economic Bulletin from July 14th, 2025. And we're also bringing in findings from the Istanbul Chamber of Industries, Turkey's second top 500 industrial enterprises survey for 2024, plus other weekly economic data points.
So quite a bit of data to work with.
Definitely. And we want to help you understand this, deepening macroeconomic fragility. Is it a crisis? Is it just these persistent structural issues? We'll look at everything from industry to finance, even technology.
Yeah, because this isn't just about the numbers in isolation, is it? It's about understanding how all these forces connect and influence each other. We want to help you get informed fast.
Precisely.
Okay, so let's unpack this. Where should we start? That industrial production figure seems like a good place.
Not a good idea.
Because on the surface, it looks positive. Industrial production up 3.1% month-on-month in May and 4.9% year-on-year. Sounds pretty good, right?
It does sound good. But like you said, here's where it gets really interesting. Despite that production bump, the real sector, the actual businesses producing their profits, aren't just eroding. They're, melting away pretty dramatically.
Melting away is a good word for it.
Yeah. And if we cut through the headline number and dive into that ICI second top 500 survey data, the picture becomes much clearer and, frankly, quite stark.
So what does that survey tell us?
Okay, so nominally, net sales for these big companies went up by 41% in 2024. Sounds impressive again.
Right, 41%.
But you have to adjust for inflation. And the producer price inflation, the YPPI, was 41.1%. So once you factor that in,
it wipes it out.
Completely. You're actually looking at a real contraction in net sales of 0.1%. And this isn't new. It's basically the same story for the last 3 years.
Wow. So 3 years of going backward in real terms for these major companies.
Exactly. Stagnation isn't even the right word. It's a decline. And maybe even more alarming is the number of companies reporting losses. It hit 159.
159?
Yes, a record high since this research started back in 1997. Just think, it jumped from 72 the previous period.
That's more than doubled.
It has. And at the same time, the number of companies actually making a profit, that dropped from 428 down to 341.
So even with more stuff being made, fewer companies are profitable and more are losing money than ever before. That's quite the squeeze.
It's a massive profitability squeeze.
And the operating profit figures reflect that too, right? Down almost 19%.
Yeah, operating profit decreased by 18.9% in 2024. And the return on sales, basically how much profit you make for every lira of sales that just plummeted. It's down to 2.1%.
2.1%. That sounds incredibly low.
It is, especially when you compare it to their own history. The 10-year average for these companies was around 7%. So we're way off that mark. It really points to a deep, deep problem with profitability.
Okay, and you mentioned financing costs earlier eating up profits. What's the specific number there? Because that sounded dramatic.
It is dramatic. This might be the single most impactful statistic. The ratio of their financing expenses, so interest payments, things like that, compared to their operating profit, it soared to 80.9%.
80.9. So more than 4/5.
Exactly. Think about that. For every 100 lira they earn from their actual operations, nearly 81 lira has to go straight out the door just to cover financing costs.
That leaves almost nothing for investment, for growth, for anything else.
Precisely. And this figure has almost doubled compared to the 2014-2023 average, which was already high at 43.4%. It shows how much value is shifting from the productive part of the economy to the financial side.
That's unsustainable, surely.
It certainly feels that way. And it's also important to mention the inflation accounting. Without that adjustment, the return on sales would look a bit better, maybe 3.4%. But the 2.1% is the more realistic figure reflecting the true economic situation.
Right, gives you the clearer picture.
And on top of all that, companies are just finding it harder to borrow, both from banks and, in the market generally. So that just makes everything tougher.
Okay, so that paints a really clear picture of the intense struggles inside these industrial companies. Profitability is getting hammered, mainly by these huge financing costs.
Mm-hmm.
So let's zoom out now. How does this internal business struggle connect to the broader macroeconomic environment? What's happening with the country's finances?
Well, if you connect those dots, you see problems mirroring at the macro level. Look at the treasury cash balance. Huge deficits.
How huge?
In June alone, the deficit was 455 billion Turkish lira.
Just in 1 month.
Just in June. And that brings the deficit for the first half of the year to date, to almost 1.3 trillion lira. 1.294 trillion, to be exact.
Wow. That's a massive amount of government spending exceeding revenue.
It is. It signals significant fiscal pressure.
And what about external balances? The current account. That's always a key one for Turkey.
Yep. Another important indicator. The annual current account deficit is running at about $16 billion. The figure for May showed a monthly deficit of $700 million. So still more money flowing out than in for trade and services overall.
Okay. And the central bank reserves, lending, what's happening there?
Right, the CBRT figures. Net reserves, if you exclude the swaps, stand at $38.1 billion. Gross reserves are quite a bit higher, $164.4 billion.
Mm-hmm. And looking at loans, commercial loans are up about 24.7% year on year, but consumer loans, they've shot up much faster, 40.7%.
That's a big difference. Does that suggest people are borrowing more just to get by rather than businesses borrowing to invest?
It could certainly indicate a greater reliance on debt for consumption, yeah, which isn't ideal for long-term economic health. And briefly, the KKM, the Currency Protected Deposit Scheme, its volume continued to decrease slightly, down 1.7% to 535 billion lira.
Okay. But despite all these domestic challenges, the company profit squeeze, the government deficit, the current account deficit, we're seeing foreign money coming in, aren't we? Particularly into bonds.
We are. In the week of July 4th, foreign investors bought in at $2.377 billion worth of government bonds and domestic debt securities, GDDS, and also about $235 million in equities.
So nearly $2.4 billion into government debt in just 1 week. That seems significant. But does that mean foreign investors are suddenly confident in the real Turkish economy, the one where companies are struggling? Or is it something else? That's a really crucial distinction to make. I'd say it primarily signals a hunt for yield.
Chasing those high interest rates.
Exactly. With Turkish interest rates being high, those government bonds look very attractive purely from a returns perspective, especially for foreign capital. It offers a perceived, safe, high return, even while the underlying real economy, the industrial sector, is facing these major headwinds.
So it's less about a belief in long-term productive potential and more about grabbing those short-term financial gains from high rates.
I think that's a fair assessment, yes. It highlights a potential disconnect between financial flows and the health of the real economy.
That makes a lot of sense. Okay, let's shift gears a bit. Let's talk about foreign trade and innovation. These are obviously critical for any economy wanting to grow sustainably.
Absolutely.
We saw that Turkey's overall exports increased slightly by 2.4% and industrial exports by 2.6%. And those ICI second 500 companies, they actually did a bit better, didn't they? Their exports were up 6.2%.
That's right, up to $15.9 billion for that group. So there is some positive movement on the export front, particularly for the larger players.
But it's not just about volume, is it? It's about what we're exporting. What about the technology level, the value added?
And that's where the picture gets less encouraging. Despite seeing some really commendable efforts in R&D, a record 238 of these companies are now engaged in R&D, and their spending is up to 62 per thousand of sales.
Okay, so they are investing in R&D.
They are. But when you look at the output, the actual value added from those exports, the share coming from high technology goods is still really low, only 3.3%.
It was 3.3%. Wow.
Yeah. Meanwhile, low-tech sectors still dominate, making up 41% of the value added.
So despite the R&D push, we're still primarily exporting lower value goods.
It suggests a persistent challenge in moving up the global value chain, shifting from basic manufacturing to producing more complex, higher margin products, and that potentially traps the economy in needing high volume just to maintain export earnings rather than getting more value from less volume.
Right. And that connects back to the profitability issue too, presumably. Lower value add often means tighter margins.
It certainly doesn't help.
Okay. And what about the labor side of things? More cost pressure there too.
Definitely another layer. While the number of employees in these companies saw a modest increase, about 2.2%, reaching roughly 291,000 people,
Right.
the cost of employing them, the salary expenses, jumped massively, up by 90.9%.
90%.
Yeah, reaching over 203 billion lira. So companies are dealing with skyrocketing financing costs and skyrocketing labor costs. It's a double whammy on their expenses.
No wonder profits are getting squeezed so hard. What about expectations? Are businesses optimistic about trade going forward?
It's a bit of a mixed bag, according to the expectation indices. The import expectation index is quite high at 114.8, suggesting companies expect to import more. The export expectation index is also above 100 at 105.5, so there's some optimism for exports too.
An index over 100 means they expect an increase, right?
Correct. And the ICI Export Climate Index, which measures conditions in key export markets, is also just above the growth threshold at 51.0. So, some positive signals.
But, I sense a but.
Well, there's always a but in economics, isn't there? There's a specific new challenge looming. The USA has announced a 50% tariff on Turkish copper exports starting August 1st.
50%? That's huge.
It is, and it just highlights how vulnerable specific sectors can be to sudden changes in trade policy or external geopolitical factors. It can quickly disrupt those positive expectations.
Okay, so a really complex picture. Internal struggles, macroeconomic fragility, some export growth but low value add, cost pressures, and now specific trade threats. Given all that, let's look at how this is all playing out in the financial markets. Where are investors putting their money in this environment? The stock market, the bias T100, was actually up, wasn't it?
It was, yes. It continued its rise in lira terms, up about 2% week on week, but that's in lira terms, remember?
Right. Inflation needs to be factored in. So where did investors find real returns above inflation?
That's the fascinating part. Gold. Gold bullion was the absolute standout performer.
Gold again.
Yep. On an annual basis, discounted by the Consumer Price Index, gold delivered a real return of 29.29%. That's remarkable.
Nearly 30% real return. No wonder it's shining.
And prices kept climbing just last week, from around $3,290 an ounce up to $3,355. Meanwhile, Brent oil also saw a rise, from about $67 to 6 cents to $70.55.
So commodities generally strong, but gold leading back as that perceived safe haven. What about fixed income? Those government bonds attracting foreign money.
They performed well too, especially on a shorter time frame. Those GDS we talked about, they provided the highest monthly real return at 2.82%.
Okay, so strong monthly returns there, which explains the foreign interest we discussed.
Exactly. It reinforces that yield-seeking behavior.
So we have the situation where financial indicators like the TLREF rate might be showing some easing. The CDS premium, the cost of default insurance, is stable, suggesting maybe some calm returning to the financial system.
Right. On the surface, some metrics look stable or improving financially.
But all the data we've discussed shows the real industrial sector is still deeply stressed. Profits are down, costs are up, loss-making companies are at a record high. There seems to be a real divergence here, doesn't there? The financial system seems to be recovering, or at least stabilizing, faster than the real economy.
That's a really critical observation, I think. There is a clear divergence. The financial markets, buoyed perhaps by high interest rates attracting capital and maybe some specific policy measures, seem to be on a different track than the industrial core.
Why do you think that is? Why the flow into financial instruments and gold, rather than back into the businesses actually making things?
Well, it suggests a lack of confidence in the short to medium term profitability of the real sector, doesn't it? When financing costs eat up 80% of your operating profit, investing and expanding that operation looks incredibly risky. Financial assets, especially government bonds offering high nominal yields, or gold as a traditional hedge against uncertainty and inflation, look like much safer bets for capital right now.
So it's a flight to perceived safety and yield, away from productive but currently highly stressed investment.
I think that captures it well.
Okay. So let's try and pull this all together. We've taken this deep dive into Turkey's economic pulse, and we've definitely uncovered that paradox we started with. Industrial production looks like it's growing on paper,
Hmm.
but company profits are just melting away, crushed by those soaring financing costs. We've seen gold reemerge as the preferred safe haven, getting that huge real return.
Right.
And while there are some positive signals in markets and foreign money chasing yield in bonds, the overall macroeconomic fragility seems to be deepening, particularly for the real economy.
Exactly. And if we synthesize that sort of strategic observation from the source materials, what it all really points to is this. Industrial profit margins are eroding rapidly. They are severely, severely strained by these high interest rate policies. Foreign trade momentum, despite some export growth, still feels weak overall, especially when you consider the low technology intensity. The R&D efforts are commendable, but they haven't yet translated into higher value-added exports in a big way.
Still stuck in low-tech dominance.
Pretty much. And while we see this clear trend towards gold and bonds in the markets, that flight to perceived safety, it highlights how the financial system seems to be recovering, or at least perceived as safer, much faster than the actual industrial sector.
And this gap, this divergence, points to deeper issues.
It really underscores this deepening fragility and highlights an urgent need for structural reforms. Reforms that can bridge that gap between finance and industry and foster real, sustainable, profitable growth in the productive sector.
Which brings us to a really powerful idea, something that resonates from the source material about how nations truly progress. The idea is, progressive nations grow by processing their raw materials, not by selling them.
That's a very potent quote.
It really is.
Yeah.
And considering everything we've discussed today, that profit squeeze, the low-tech export structure, the capital flowing into finance rather than factories, it makes you think, what actual steps, what tangible shifts do you think could genuinely move the balance for this economy? Move it away from just extracting or basic processing towards that high-value processing and manufacturing? It's a big question, but it feels like the core one.
It is the core question, and it involves tackling everything from the cost of capital to educational reform to targeted industrial policy to creating a more stable and predictable investment environment. It's complex.
Definitely complex. And it's a powerful thought, perhaps, for you to mull over long after this deep dive. How do you get from selling raw materials to truly processing them for higher value? Something to think about.